Let's now have a look at the business purchase. So we just checked business sales. In business purchase, we obtain the goods or services with an agreement to pay at later date, or at the same time you can also pay in cash. But whatever it is, we have service accounts or nominal accounts for each expense. We have rent, telephone, post, professional fees. Whatever account you will use, the journal will log something like this. So we would have debit and credit again. We have service account, let's say would be rent account. So we put rent account here, and debit expense account, and credit payables. If we would be paying straight away, we'll put cash instead of payables. But because we agreed here to pay within 30 days, we'll put in payables, and we clear it, the payables account, once the payment is actually made. Inventory. So for the businesses that sell items or goods, it's important to keep a track how much stock you have in your warehouse. So if you recall, we have talked about goods of cost of goods sold, and I said we will talk about this a little bit later, because this particular amount is actually combined of beginning inventory balance plus the purchases less ending inventory. So whatever we have at the end of that particular period. So typically it's accounting period. You have a stock check. You make sure you close or post the business so you don't miss anything. Then we have to calculate cost of goods sold. So let's say we have purchased some goods, and simultaneously we also have sold some items, right? So as you recall, we have a sale, which is recorded with receivables because of delay in payment, and we have to record our cost of goods sold same time because we sold some items, right? So we have to record our inventory is 500 sold and 500 cost of goods sold. Fixed assets. Fixed assets belong to the business. As you remember, we own these business items. When we buy equipment, we will use that specific account. So if there would be machinery, we'll use machinery. If there will be equipment, we'll be using equipment. Building. So each of those will have their own nominated account. With the fixed assets, what you need to remember is that fixed assets depreciate, they lose value every year, or in other words, we have to write off a small amount every year to get actual value for goods, because the things deteriorate. The laptop that you bought 5 years ago, it's not new anymore. So every year we'll lose the value and we depreciate it in a way. We bought equipment, we debit equipment, it's an asset, and then we pay, so we reduce our cash.